Welcome to Halal Money Matters, presented by Saturna Capital. I'm Christopher Patton, Saturna's cultural attaché, and I'm here again with Monem Salam, Executive Vice President at Saturna. Hello.
Hey, Chris. How's it going?
Good. I'm glad to have you back. I'm glad we're doing this again.
Yeah, it's really exciting. Our last episode went really well. I think we got to talk a little bit about the why.
Just recording it, we had so many things we wanted to discuss, so many avenues we found ourselves wanting to go down that it was not hard to envision a full slate of these, so I'm excited to be back and build on what we talked about last time.
Yeah, and if listeners ever have any thoughts on what topics we should do, maybe we should kind of invite them to
Absolutely.
give their feedback.
Yeah. So in the last episode, we did talk about the why, and I think where we left it off was the how.
Yeah.
So I think today the idea is to discuss a little more about Islamic finance, kind of an overview, and then maybe get into the details about what makes an investment halal and what can we do in this space.
I think that's a good idea.
So give me like the elevator pitch for Islamic finance.
So that's if you really technically think about it, it actually goes back 1,400 years.
Sure.
To the time of the Prophet. And their general rule when it comes to finance, and one thing to keep in mind is, that Islam is kind of broken up into two different categories. One is called the ibadat, which is the worship, and the other one is called the muamalat, which is your daily interactions. And so that's two different bodies of understanding that are there, and part of finance is the daily worship part of it. And so what the general rule is that anything that God or the Prophet prohibited us from doing, then we would be prohibited from investing in also. So, for example, in the Quran, you find the prohibition on gambling and alcohol. So we would not be allowed to invest in companies that are involved in gambling or alcohol. So that's generally how the guidelines started. Within that area, there's a larger group because alcohol and tobacco, those are kind of the smaller areas.
Sure.
The larger group is actually having to do with both what's called riba, which is interest, and the second category, which is called gharar, and that's speculation. So those are two large areas that probably a lot of people talk about the riba aspect, but not the speculative aspect of it. And I think those may make up a big section of Islamic finance as well. So then fast forward, I think that throughout the Ottoman Empire, all the different empires that happened during the Muslim Islamic states, they did for the most part practice, Islamic finance from that perspective. When the colonial powers came in, they pretty much, gutted out the system and put in their own. And so if you look at, post-colonial in the 50s, 60s, most of the Muslim countries don't actually operate under Islamic finance rules. And that's something that people talk about, well, the majority of Muslim countries, why don't they do it? And that's one of the main reasons why they're not there. So there's a difference between a Muslim country and an Islamic country. So and there's really none that are out there right now. So in the 1950s and 1960s, there were a lot of professors and scholars were thinking about this idea of how do we bring Islamic finance back. The first, I think, iteration of that was in 1969 when the Hajj Fund of Malaysia was started. And obviously, because if you want to go for Hajj, you want to keep your money pure. So they wanted to make sure that they were keeping in line with Islamic guidelines. And then in 1975, there was two groups. One was in Emirates, the Islamic Bank started, and also the Islamic Development Bank. And then you fast forward in the 1980s, you have different funds in the U.S. that began, and then really took off in the 1990s. Now, the actual guidelines, if you look at it from an investment perspective, which that's what we're primarily going to be focused on here,
sure.
Right? They're a function of two things. One is the knowledge of the scholars and what should be and should not be part of the guidelines. And the other part of it is technological advances that have taken place. So, for example, in the 1960s, if you told people to do certain things, if it came to screening out balance sheets, you'd literally have to have human manpower going in, looking at physical copies of annual reports, making those calculations. Well, now that's done all on Edgar filings and computers, so a lot easier to do. So I think both of those things marry each other well when it comes to the guidelines.
And so it seems that the primary act of finding like what is an acceptable investment is to exclude. There's an exclusionary process that says we're trying to isolate and identify the investments that are permissible.
Yeah, I think that the guidelines are made up of let's say three categories, and two of them are exclusionary and one of them is inclusionary.
Okay.
The exclusionary ones start off on a business screen basis and says, if a company's primary business is something that's haram or not prohibited, then that would not be acceptable as an investment. The second is also exclusionary. It basically looks at and says what are acceptable ratios of companies that are involved with something that's forbidden.
And so by that you would mean a company that's primary business is one thing, but may have a very tiny part of their business that involves a certain activity?
That's one part of it, or a tiny part. Like I think my classic example that I use is an airline.
Sure.
Airline is in the business of transportation, was in and of itself is permissible, but they do sell alcohol on their planes.
Sure.
And so, how much of that would be tolerable from an Islamic perspective? But the other bigger aspect of it is, a lot of companies borrow money and they have to pay interest on. A lot of companies have cash on their balance sheets and they get money from that. So all of those things have to be taken into consideration as well. There's a funny story actually that, initially when the guidelines were being created, one of the scholars said, debt is really bad and I don't want companies to pay interest on any company that they're borrowing money. And so the practitioners went back and they did some research and they said the S&P 500, 50 companies actually have no debt on their balance sheet, which is pretty good. We can make a fairly diversified portfolio from that. But a second scholar said, well, that's good too, but I also don't want companies that have bank accounts because the bank charge interest, and we don't want that either. So, Chris, how many companies do you think there are in the S&P 500 that have no cash and no debt?
I'm going to say around zero.
That's probably pretty close. It's probably right. And so that that guideline didn't work. So
Sure.
that's where the tolerable limits began to be implemented because the scholars realized that it's not possible otherwise.
So when you mention the scholars, I'm curious, is there an agreement among scholars? How are these numbers arrived at? Are there differing views?
That's a good question. I mean, I think that from our overall perspective, I would say that there is an agreement. So, for example, nobody would argue that you shouldn't be investing in alcohol companies or those type of things. Nobody would argue also that even looking at debt to market cap or debt to assets, those ratios should be looked at. What you get into disagreements on is maybe percentages. So is it 30, is it 33%? And then you also look at valuation metrics. So, for example, do you want to use market capitalization as a value of a company? Do you want to use total assets, enterprise value? And those are disagreements that are not in form, they're more in substance. What is the true value of a company?
Sure.
And I'm sure analysts, just secular analysts, would argue about that as well.
Absolutely,
So,
yeah. So if companies, they're changing their business, they're adding, they're constantly re-envisioning their businesses, it seems that it would be common for a company to go from halal to haram just overnight. What does that look like, and who's watching that?
So, I mean, I think that's a good point you raised. Companies, either through mergers or acquisitions or a change in business strategies, can always fall in and out of compliance. As an example, you can use as Amazon. So, as you know, Amazon a few years back received its alcohol license in Washington. So, an investor can look at this and say, well, they're eventually going to get into the business of selling alcohol, which is not acceptable. And so, they can choose to exit it prior to them selling the first dollar of their alcohol, because there's plenty of advance notice that was given, or that the day that they actually open up their stores is when you can sell it as well. And, in retrospect, you look at it and say that, well, Amazon has had a tremendous run after you would have sold it. But again, these guidelines are set up not for only the pure returns, but also based on your heart and what's going to happen to you from your values perspective.
How widely known in the Muslim community are these guidelines? How widely practiced is this? Is this something that you are constantly educating about?
Yeah, so I mean, you would think that a lot of people would know about it. We've been doing this now for quite a few decades, and I think it really became popular in the early 2000s, and myself and other people began to go traveling the country and giving seminars and stuff. So you would think that everybody would know about it, but really, every day we come across people that are like, "Oh, I've never heard of Islamic investing before," and they're Muslim. So it's a good opportunity for us to keep educating people about what is allowed, what's not, and what the consequences are. The one thing that I didn't mention earlier was when I was talking about the screening. I said there was two exclusionary, one inclusionary. So the third one, which is the inclusionary part, the idea is to really invest in companies that are doing things that Islam encourages, or even just it's good for society. There's actually a verse in the Quran which God says, enjoining the good and forbid the evil. And, like they say, the past 30, 40 years of Islamic investments, we've really been only forbidding the evil. We won't do, it's all exclusionary, right? But I think the inclusionary part of it, which is those companies that are doing good, is actually part of the second part of that verse, which is in joining in the good, we're beginning to implement that as well. And it's really exciting. And again, probably 30, 40 years ago, that probably would not have been possible based on technology and also on understanding of the scholars. But now we're able to do it. I'm really excited about the next 10, 15 years of seeing where we can go with this.
An added element of that to me would be that companies now are doing more reporting on the good with the kind of rise of ESG metrics. Companies are more incentivized to demonstrate the good that they're doing as opposed to just the bottom line. So we're probably seeing more reporting, more numbers, more metrics.
Absolutely, and it's only going to get more and more. And I think that the companies that are involved in Islamic investing do have somewhat of an advantage in that we have the screening methodologies in place. We have a formalized structure. For example, if you look at the ESG space, it's everybody does whatever they want. It's pretty much all over the place. Whereas in Islamic investing, there is a general consensus, as we were mentioning earlier, that the scholars agree upon. And there's a formal structure of the scholars auditing the portfolio, making sure you're following the guidelines, doing all of those things. That's not there yet in ESG. That's where I think our industry can help establish the rules of what that looks like. And that's really exciting as well. So, I think generally, if you look at different indices, people always ask the question, like, am I going to get hurt by investing Islamically or not?
Missing out.
That's
yes,
right. As one of my colleagues once mentioned, he called it the COBM, which is cost of being Muslim. And he was joking around, but
sure.
Is there one? So are you sacrificing returns when it comes to living by your principles? And I think the general answer that we found is you're not hurt or you're not helped in the long run. And what I mean by long term is taking it on a 10-year, 15-year basis. So if you look at, for example, an index, and you take that same index but you screen it Islamically, and you look at the performance over a 15-year period, there's actually statistically no difference between the two. There will be periods when the index outperforms because of certain industries that Islamic guidelines are not allowed to buy, banks and those things, that they will outperform. And in other cases, Islamic compliant investments will outperform. So, for example, in a recession when debt is not looked good upon, obviously, we're in Islamic investing, we're looking at low-debt companies, so we'll outperform. So on a period-by-period basis, it could be either way. But I think on a long-term basis, I think there's statistically no difference. And that statistically no difference is important for a fund manager, only because it levels the playing field for us to be able to outperform an index. And that's really what active fund management is all about. And so that's what we're trying to do.
And when you talk about taking a long-term view, that's kind of what we want to be doing anyway, right? With the limitations on speculation. That favors a longer-term investment horizon, right?
That's correct. People can look at the stock market as a gambling tool, or they can look at it as a way to be able to build wealth. And really, the guidelines were set up so that an average Muslim could build wealth over time with the use of the stock market with small dollar amounts. And so, from that perspective, you do want to keep in mind the long term, which is, I'm saving for my retirement in 30 years. I'm saving for my children's education in 20 years. Those are the types of things you can do. Now, you can have short-term investments. I want to buy a house in 2 or 3 years. How do I save up for the down payment? All of those things are there, and
sure.
And these funds in general, Islamic investing can be used for those purposes. But generally speaking, it's not about day in and day out trading. It's more about holding it for the long run. So there's the 3 really great resources. And the first one is actually our newsletter that Saturna comes out with. The Art Arm has a good article on Islamic investing and the history behind it. And then there's actually 2 books that are also on our website. That's www.saturna.com. The first one is called A Muslim's Guide to Investing in Personal Finance. And that one actually goes through and talks about each of the different areas of Islamic finance, not only from investing, but also mortgages and zakat and 401ks. So it's a good primer. And then the second one is written by Dr. Yaqub Mirza, called The 5 Pillars of Prosperity. Both are available on our website, so if you go there and ask for a copy, somebody from our office would be happy to mail you one out.
Yeah, we have a nice form to request those for free to be mailed to you.
Yeah.
So that's a pretty sweet deal.
We have a very special guest that I'm really excited about for the next episode, Owais Dadaboy, who is our Director of Islamic Investing at Saturna Capital. He's been involved in the finance industry for a very long time, over 20 years, joined us in 2008. And since then, he's been very active in really educating the Muslim community. And I'm, like I said, overall, I think he's a great asset. And I think I'm very excited about the next episode.
All right. Thank you for being here.
Okay, thanks, Chris.
I'll see you. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Amana Funds in a current prospectus or summary prospectus, please visit amanafunds.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing. Investing involves risk, including the risk that you could lose money. The Amana Funds restrict investments to those companies consistent with Islamic and sustainable principles, which limits opportunities and may affect performance. This material is for general information only and is not a research report or commentary on any investment products offered by Saturna Capital. This material should not be construed as an offer to sell or the solicitation of an offer to buy any security in any jurisdiction where such an offer or solicitation would be illegal. We do not provide tax, accounting, or legal advice to our clients, and all investors are advised to consult with their tax, accounting, or legal advisors regarding any potential investment. Investors should not assume that investments in the securities and/or sectors described were or will be profitable. This podcast is prepared based on information Saturna Capital deems reliable. However, Saturna Capital does not warrant the accuracy or completeness of the information. Investors should consult with a financial advisor prior to making an investment decision. The views and information discussed in this commentary are at a specific point in time, are subject to change, and may not reflect the views of the firm as a whole. All material presented in this publication, unless specifically indicated otherwise, is under copyright to Saturna. No part of this publication may be altered in any way, copied, or distributed without the prior express written permission of Saturna Capital. To the extent that it includes references to securities, those references do not constitute a recommendation to buy, sell, or hold such security, and the information may not be current. Accounts managed by Saturna Capital may or may not hold the securities discussed in this material. The S&P 500 is an index comprised of 500 widely held common stocks considered to be representative of the U.S. stock market in general. When available, Saturna uses total return components of indices mentioned. Investors cannot invest directly in the indices.